Welcome and thank you for joining this Each One Teach One financial literacy series video where we will discuss the cost of home ownership. My name is Nikki Vandenheuvel and I am a Learning and Development Coordinator with Fusion Credit Union, as well as a certified Each One Teach One financial literacy coach. Fusion has partnered with Each One Teach One as a way to provide our members with financial education options so that they can confidently manage their finances. Before you buy a home, it's important to understand the upfront and ongoing costs associated with home ownership. It's also important to understand how your mortgage works. Educating yourself on how mortgages work and about the mortgage options available to you will help you save money and better prepare you for costs of owning a home. Let's begin with a question: true or false? How much you can afford to spend on your home depends entirely on your annual income. The answer here is actually false. Although your annual income is an important factor in determining whether you're in a good financial standing to consider home ownership, it's not the only factor. The amount of money you've already saved for a down payment, as well as the amount of debt you're currently carrying, are also factors in determining how much you can afford to spend on a new home. The maximum home price you can afford depends on a number of things, including your gross household income, the size of your down payment, the mortgage interest rate, your personal preferences, as well as gross and total debt service ratios. Remember, you aren't obligated to spend the maximum amount on a home. Just because you qualify for a large mortgage doesn't mean you should always take it. It is important to feel comfortable in your financial dealings. So how much can you afford? We are going to take a look at 2 affordability rules. Number 1, housing costs should not cost more than 30% of your gross monthly income. And rule number 2, your entire monthly debt load should not cost more than 40% of your gross monthly income. So let's take a deeper dive into Affordability Rule 1, Gross Debt Service Ratio. So to reiterate, your housing costs should not cost more than 30% of your gross monthly income. To calculate your gross debt service ratio, we take your monthly total housing costs and divide it by your gross monthly income. If the resulting figure is greater than 30%, your housing costs may be too high to sustain and you may not be ready to purchase a home. Affordability rule number 2 is total debt service ratio. So in addition to having your gross debt service ratio below 30%, it's also important that your total debt service ratio fall below 40%. That is, your entire monthly debt load should not cost more than 40% of your gross monthly income. To calculate your total debt service ratio, take all of your monthly housing costs plus your total monthly debt obligations and divide this figure by your gross income. If the resulting percentage is greater than 40%, you may not quite be ready for home ownership. Remember, these ratios are used by lenders to determine risk through affordability. Caution should be exercised as what you can afford and what you qualify for can be very different things. It's very important to determine your own personal budget. True or false? When buying a home, it's important to plan for costs beyond the purchase price of your new home. Well, this is absolutely true. There are many costs involved with buying and owning a new home beyond the initial purchase price. As you plan to purchase a home, it's important to understand what these additional and ongoing costs are and to plan for them in your housing budget. So what kind of costs are part of purchasing a home? We're going to take a look at things like purchase and sales costs, closing, other, and ongoing costs as well. First up is purchase and sale costs. Purchasing a home involves many additional expenses beyond the purchase price. When planning to buy a home, it's important to understand all of the associated costs. Let's start with down payment. This is the portion of the price of a home that is not financed by your mortgage loan and which you must pay out of your own savings or other eligible sources before you can get a mortgage. You can expect to pay at minimum 5% of the purchase price as a down payment. Property appraisal. This is not always required. However, this is the fee for determining the property lending value for mortgage purposes. Costs for appraisals can range depending on your location. However, most lenders will only allow fully accredited and approved professionals do their property valuations. A property survey. Again, this is not always required. However, a property survey will determine the boundaries of the land and positions of major structures on the property. These can cost anywhere between $750 to $1,500, again, depending on your location. Home inspections. A home inspection is not mandatory, although many people make a professional home inspection a condition on their offer to purchase. A home inspection evaluates the structure and systems that make up a prospective home. CMHC premium and application fee. In order to secure a mortgage, you may need to secure mortgage loan insurance from the Canadian Mortgage and Housing Corporation. The cost of this insurance is calculated based on the size of your mortgage loan and the size of your down payment. Lastly, real estate fees. This is the commission that you pay your real estate agent for brokering a home sale. This varies by region and by agent. When planning on buying a home, be sure to ask your local real estate agent what their fees will be. Closing costs are the costs that you will have to pay in addition to the purchase price of a home on the day you officially own it. These costs include legal fees, transfer fees, and various disbursements. They usually range from 1.5% to 4% of your purchase price. As you plan for these costs, you'll want to understand what additional expenses you'll be required to pay for your new home. Some other additional costs that are related to purchasing a home may include the following: GST if you're purchasing a new home, property transfer fees, legal fees and disbursements, property-related adjustments, and appliances and furniture. Purchasing a home means the beginning of home-related expenses. Indeed, owning a home comes with a host of ongoing costs that you'll need to understand so that you can make them part of your home buyer's budget. These include property taxes, property insurance, fire insurance, utilities including water, heat, gas, and electricity, maintenance and repair, and can also include things like security or alarm services and lawn and garden maintenance. It's important to include these items in your plan. In addition to your responsibility to your mortgage, owning a home comes with a host of additional financial responsibilities. Planning for these additional costs before they surprise you is a good idea and will allow you to comfortably and responsibly manage your financial health. If you would like to know more or have any further questions, I encourage you to reach out to your financial institution for assistance.